stop downloading stuff. Oh, for those watching the video back at home, we're in a chalet with literally the world's worst internet, and you can barely, yeah. So Mo has been hogging all the bandwidth, watching high definition videos, making everyone else suffer, and now I can't even load a chart. Talking on the lift earlier, and this is pretty old school, which is still valid, and for some reason a lot of people don't realise this. So typically, when here this red line is interest rates, okay? So the red line is interest rates. Historically, what happens if you were to plot house prices next to this? So you see, I don't know, let's say house prices are just doing this. Now, ignoring random government policies like stamp duty windows, whatever, you see a massive rise in interest rates. You tend to get a little uptick in house prices because the smart money goes, holy shit, high interest rates, things are not going to get good, and there starts a little bit of house selling, and you have like a weird house price boom. But what happens is eventually, I haven't drawn this properly, as this goes up, I've gone too far forwards. There we go. As interest rates goes up, you then have a big dip in house prices. But there is a lag, so I haven't drawn this properly. But then eventually, as house prices starts to really drop, interest rates start to drop as well. And then you have this sweet moment where you have relatively low interest rates, low house prices, and this is where the house prices gets in front of rates. House prices then starts to do this, whilst interest rates are then bottoming, and you have this sort of dance. So if you look at UK data over the last sort of 60 odd years, the best times to buy a house is 6 to 18 months after peak interest rates. So if you have peak interest rates here, whatever it may be, let's just call it 10%. I don't know. I'm just making up numbers here. At that line there, that's 10%. That's peak interest rates. The best time to buy a house is 6 to 18 months later, because house prices would have bottomed. And then you get some sort of sweet, beautiful area where you have relatively cheap house prices, and also maybe not low interest rates, but lowering interest rates. So the trick is to buy the house on, let's say, a variable rate, because you can see the interest rates now on the way down. So you have it on a variable rate, and at some point when you see interest rates bottoming out again, all charts bottom out like this. When you start seeing it, slowly tick up, based on world economics, what the market's doing.
Where can you see the chart of the interest rates in the UK? Also?
I'll show you.
Where is, okay.
Here on TradingView.
On TradingView, again.
Yeah,
yes.
look. I've got it saved, but if you just type United Kingdom interest and just let it pop.
But we had a long time of very low interest rates, so people need to buy houses. So it looked like anomaly on its own, no?
Sorry?
The interest rates, which
were
were
been
very
rock
low
bottom
for a very, very long time,
yes,
and people still need to buy houses.
Yeah.
So this advice would not be applicable to such anomalies like what we had, yes?
Sort of. I'll come on to that because I'll talk about the next thing. Will explain that.
Right.
Okay. So yeah, if you then just type United Kingdom interest, whatever, so you got that one. There's US interest rates. What else is there? Yeah, there's a few. Yeah, so that one. If you click that, it will show you UK interest rates.
Yeah, indeed. So that was the decade, yes, of very, very low interest rates. Yes?
Yeah. Or just over a decade. So 2009 and yeah. Now, just let me finish this bit and then we'll come on to your question. So, typically, the old school method is about a year after interest rates peak, house prices bottom, you buy it on an interest only mortgage, because as interest rates are coming down, you're getting the benefit of that. Once interest rates start to bottom out, then you fix your mortgage. So somewhere around here, you fix your mortgage for as long as you freaking can.
10 years.
10-year, whatever. Or actually, if possible, remortgage as well. So you remortgage and lock it in as long as possible, because your mortgage is always going to be the cheapest form of money you can ever borrow. And then eventually, depending on the market, you can sell your house. But going back to your question, so this obviously since 2008 really, things all changed because they're doing quantitative easing and blah 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 blah, and interest rates have been held low on purpose for the best part of a generation really. It's been what in the UK 0.5% for seems like forever, hasn't it? And this is a big deal. Like let's say 0.5% is normal, and where we are right. Oh come on. Here we go. Look at that. It may look like we've gone from 0.5% to 4% and it's not a big deal, but look at the growth. That's a 737% increase. It's absolutely phenomenal what's going on here. So now, I'm sorry Case, I've already shown you this, but I'm going to double it again. Feel free to go to sleep. So the way to actually not worry about is this metric in sync or not is just to have this overriding principle of valuing anything you want against the currency supply. That's it. And that will always look after you.